Good morning and welcome to the Killik and Co market update. We've had lots of UK economic data out this week, and first up was UK government borrowing for the month of October, which came in way above expectations. Here's UK government debt over the last 15 years. It's currently over £2.8 trillion, and it's more than doubled over this time period. For the month of October, the UK government was expected to need around £12 billion worth of additional borrowing, but the actual number came in at over £17 billion. One reason given for the high figure was an increase in the amount of interest that the government is having to pay on its existing borrowings. The interest bill for October was over £9 billion. Here are the monthly interest payments going back to 2020. There has been a general upward trend thanks to the additional debt that was taken on during COVID. About a quarter of the government's outstanding debt is inflation-linked, and the interest is generally paid twice per year, so you can see in 2022 there were some big interest bills when inflation was very high. The yields on government bonds have risen since 2021 as the UK's base interest rate has gone up, and we've also seen a rise since the autumn budget. This won't impact the interest payable on existing debt, but it means the government will have to pay more on any new borrowings. The 5-year gilt yield was briefly around the 0% level back in 2020, but it's currently around 4.3%. British retailers have been quite outspoken this week on the subject of the increase in employer national insurance contributions and the increase in the minimum wage, both of which were announced in the autumn budget. Retailers are big employers and therefore will be significantly impacted by these changes. The British Retail Consortium has coordinated an open letter to the Chancellor, which has been co-signed by Next, Boots and Marks & Spencer and backed by 79 retailers in total. Here are a couple of the key points. For any retailer, large or small, it will not be possible to absorb such significant cost increases over such a short timescale. The effect will be to increase inflation, slow pay growth, cause shop closures, and reduce jobs, especially at the entry level. This will impact high streets and customers right across the country. We've already seen a tick upwards in inflation recently. The latest data came out this week, and here's the 5-year chart. The rate was up from 1.7% in September to 2.3% in October. Since the budget in October, we have seen the UK's FTSE 250 index dwindling downwards. The index is thought to be a good barometer for the UK economy, and its performance likely reflects pessimism over economic growth in the short term. And to finish up, we thought we'd highlight that it's not all doom and gloom in the retail sector at the moment. This week we had results from TJX, which is the owner of TK Maxx. The market was happy with the results and the shares moved on to a new record high. Here's the 5-year chart. TJX is the world's largest off-price retailer. A lot of other clothing retailers have been struggling recently. TJX has a lot of buying power and it's been able to buy stock from those other retailers at attractive prices. And then customers have been shopping more in TJX on the lookout for bargains. So do give us a call if you'd like to talk about this stock in a bit more detail. Moving on to have a look at next week, it's looking fairly quiet on the corporate calendar. We've come to the end of earnings season and we're not expecting results out from any companies on the Killik & Co covered list. Have a great weekend and we'll see you next Friday.